Jinesh Gopani now joins us. Let's talk about markets, valuations, what he's been doing in this kind of a market and where he's picking up his spots in this so-called liquidity-infused market. Jinesh, good morning. Thank you for joining us. Jinesh, there are two types of people in this market. Those who are part of the carnival are feeling happy because markets are behaving like a carnival. Every day things are going up. And those who are not part of the carnival, which is they are worried about valuations, they are not investing, and they are waiting for markets to decline. As a fund manager, you have a compulsion to invest. But for someone who's sitting at home right now, has missed the rally, what should that person do?
See clearly, even this rally has been a bit of a surprise to people like us also. When there was a lockdown, things were very, very grim, very negative. All sorts of worries were around. Frankly, most of the businesses had come to halt closer to zero. And as the economy opened up, things are looking up. There are signs of recovery starting from rural India to semi-urban, and hopefully in next 1 or 2 months, if top 5-6 cities where the infection rates are high, hopefully if the infection rates starts plateauing down, then there is a hope that even the businesses can start in a much better manner in those cities. So I think we had a very sharp fall when the lockdown was initiated. Markets came down 30-35% from the low of 7,800. If you take the base around, we are up 30-35% again. So now you are in middle of that rally, I would say, or the fall. And clearly, as the numbers are coming, people are trying to invest wherever there is a hope of numbers being better than the others. Also, I was just hearing your earlier comment on big is becoming bigger, and that is clearly the point. India being a bottom of stock market story, the companies which can grab market share, companies which are efficient and are able to survive this phase, will definitely become bigger and bigger over a period of time. And hence, right to win business strategies will take a front seat. Strong management, agility of that management to drive the numbers will be very, very important. So I think clearly you are seeing even in some of the numbers which are coming recently, and it has been a surprise to the market and some of the investors. And hence, I think we are in for a very, very stock specific kind of stories from here on, where the companies which will do well first will get that thumbs up, and rest will follow as and when the numbers pick up on a broader scale. From a market perspective, clearly, frankly, we are in unprecedented time. We don't know how things will pan out, whether there is a second wave, third wave. We are still continuing the first wave of this health crisis. And hence, we have to be cautiously optimistic and look for only stories where there are strong managements and are able to navigate this phase better.
Jinesh, but for large companies to survive, the smallers also have to be in business. I mean, HDFC Bank can only lend if down the ladder companies, SMEs and MSMEs are doing well. Similarly, in every sector, wherever the migration is happening, the migration may benefit large companies, but the smaller companies also will have to survive. So at a time when the smaller companies are struggling at MSE level, at SME level, the large companies may have great models, great temples, great processes, but if the economy per se is suffering, even the large companies will feel the heat.
So you are absolutely right. So initial start would be to look into the companies who will survive this phase, be it strong balance sheet, strong management, as I was saying. The second leg would be, we hope that economy will start reviving in the second half of this fiscal year. And hopefully by that, we have some demand side stimulus from the government. Then I think that will just add to the revival. But Nikunj, if you really see, out of 700 odd districts, at least 60-70% of the districts are opened up. They are doing business. Even in the cities like Bombay or Delhi or Chennai, it is not that everything has come to the standstill, which was the case, let's say 2.5 months back. Here also, if you take the e-commerce as a business model, clearly the vendors to those e-commerce are better, I would say, what they were 2 months back, as the e-commerce has opened up and is really doing well. I'm sure you would be seeing in your buildings also the amount of e-commerce the packages which are coming. So clearly, I see. I'm not saying that everything is hunky dory. It is just that you were into the lockdown and things were very grim, very negative, and you have on the other side very strong liquidity flows globally. If you take emerging market flows, again are back, and we are also benefiting out of it. You take some of the companies who are raising funds. Clearly, it's a massive fundraise which is going on. So at least I would say the money is available for these strong companies. The money is available in plenty if you want to raise capital and if you are a strong company. And hence, I think it is case of first survival and then look for a big growth, maybe not now, maybe 6 to 9 months down the line. So you are right. You need more broader base recovery, and hopefully that should happen maybe in 6 to 9 months' time if we are able to avoid this health crisis in a much better way.
Jinesh, where do you think this entire self-reliant stroke Atmanirbhar Bharat will take us? Because this, some would argue, could hurt our exports. This, some could argue, could have an impact on a auto or some companies which are dependent on Chinese and imported products in order to manage supply chain. What I'm trying to understand from you is that one side of looking at this Atmanirbhar self-reliant campaign is that Indian manufacturing sector will get a boost. But the other way of looking at this is that, look, there are existing supply chains which are dependent on imported substitution because of quality and pricing. They will get disturbed and they will get disrupted.
True. So it is too early to say how the stance is being looked for. What we understand is if any overseas company who wants to set up its base in India for India, I think government shouldn't have any problem. And that is why if you really, I'm not going into a argument on discussion with for India, China or something like that. But I think that the corporate tax rate cut which they had come out last year in September, clearly the focus was to bring in some of the manufacturing, let's say, bases to India. So be it Apple or be it any other company. Even if you remember, maybe 3 to 4 years back, Foxconn was ready to put in big money in Maharashtra. So I feel the stance is more to reduce the trade deficit by manufacturing. Let's say, for example, if you are manufacturing mobile phones, why not have most of the stages of this manufacturing of mobile phones in India by setting up bases in India? So I think still we are unclear whether it is only for the Indian manufacturers to manufacture for Atmanirbhar Bharat, or you will be allowing Apples of the world to come to India and create jobs. I think I would say later is more important, because you need to create jobs in a big way, and also you need huge amount of capital to set up shops in India. I think the most important part is the red carpet which is needed now in terms of approvals, be it land, labor or capital. And if government is able to initiate that process in a much better manner, then I think clearly we could have a big turning point, maybe not now, maybe 18 to 24 months down the line. So I think still we need to understand that because we are in the globalized world, the entire supply chain management is very globalized now, and you cannot impact that supply chain disproportionate. I think more, I would say my understanding would be it is more to bring investments and the companies in India to manufacture for India and maybe for export purpose as
well. Okay. Jinesh, I want to get your perspective, and since markets have been on this continuing high, we've kind of not looked at the shape of the recovery recently. I want to get your perspective on whether you think this is a clean sweep now going ahead, or whether you're still anticipating things will be volatile over the next few months.
Very difficult to guess whether it will be a V-shaped recovery, W-shaped recovery, L-shaped, U-shaped. I think everyone has come out with all shapes of recovery. I think it is this event is an unprecedented event. It is a black swan event. Nobody knew 2 months back what will happen, and suddenly everything is looking hunky-dory. I think we should be cautious, but cautiously optimistic as economy has opened up. But we feel that there could be heightened volatilities globally as well as in India if any event has to come, maybe in the form of second phase or third phase of this crisis, or you have an US election coming October, November. Again, can there be a volatility around that globally? You have geopolitical tensions also going around. So I think it is better to play carefully rather than going gung-ho or being into an overconfident kind of a mode.
So at these valuations now, and 2-3 months post, we've seen all of the medical news unfold. At these valuations, would you continue to buy into your preferred names at dips, or would you now hold out, wait to see how things pan out?
Clearly, we would wait for numbers to come. At the end of the day, if numbers don't come, then any which ways, whatever is the valuation, it gets crashed. So be it 10p or a 50p or 100p stories. I think clearly June quarter is going to be a washout quarter. However, if you really see 2-3 previews which have come, especially from the financial sector, are better than the estimate, I would say. Though it is not that everything is fine, but at least it is better than what was envisaged, let's say, again, 1.5-2 months back when things were on the lockdown. And hence you are seeing some recovery coming back into those names as people are trying to adjust some of the numbers from a lower side to slightly on the upside. But as I said, you need to really wait for economic recovery to be broad-based, and that will happen only in the second half of this year. We have, looks like we have discounted that for at least to the extent of 50-60%, that there is going to be a recovery in the second half. Now numbers have to support that. So clearly, maybe not June, but September quarter numbers will be very, very carefully watched. And the commentaries which come after the June quarter numbers from the managements will be very, very carefully listened to really understand where we stack up for FY22. I think FY21 first half is written off, second half there is a hopeful recovery. People have started looking for FY22 when they are putting a lot of money into the QIPs and the stake sales which are happening, and if we have a situation where FY22 will be back to good growth levels, I don't know what the growth levels would be, then I think markets can climb higher slowly, steadily over a period of time.
Right. Jinesh, I'm just looking at the performance of your long-term equity fund as well as the Focus 25 fund as well. And the 3-year CAGR is quite impressive given the performance of the markets from March onwards. But tell me, would you be looking to make any changes in any of these portfolios at all?
So we have made changes when we went into this crisis. Obviously, we are also learning in terms of what will be the new normal. to the economy, which companies in which sectors really get benefited, and which sectors might take a longer time to bounce back. What kind of stimulus can come to those sectors to revive demand. So clearly, we have made some of the changes wherever necessary. Having said that, we fortunately for us, we always have been into good quality companies, and we have seen those quality or the business models get tested in the difficult periods of the market. And at least from a fundamental point of view, we are very happy that the companies where we are invested are doing their best in the sector to sustain or survive in the near term, and become a winner over next 2 to 3 year period of time. So to that extent, I think we are okay with the portfolio what we have. Having said that, as I said, we are into these volatile times. How things will shape up will be known only over next 3 to 6 months time in terms of demand. We should not forget that India is a domestic consumption story, and if the consumption doesn't pick up for whatever reason, if there are more job losses, then I think the entire story gets elongated more. So I think as I said, we are careful. We are not ignoring any sector at this juncture. We are going granular in terms of understanding each company in a sector, and trying to invest wherever best possible into the companies who are able to survive the shock of this unknown, and get into growth mode as and when economy recovers in next 6 to 9 months time.
Sure. I see a lot of mid-caps as well, Jinesh, in your funds. An Info Edge, for instance, a Pidilite as well, although I'm not quite sure you can really call this a mid-cap in that sense, because this is a portfolio must-have. But where within mid-caps are you finding newer opportunities, special names like an Info Edge, which are, one of a kind in that sense?
So clearly, as these dislocations are happening in the business model, it would be difficult to find many stories in the mid-cap or the small-cap space, because everywhere, if you take each and every sector, and we have been doing this reviews for last 3 months continuously, everywhere in a sector you have problems for tier 2, tier 3, tier 4 companies as of now. And that is clearly seen because let's say the company was riding on huge debt for growth, and now is facing problem for not getting required funding, or the company's business model itself has gone for a significant change because of the COVID-related issues, which has impacted some of the sectors like travel, tourism, hospitality, commercial real estate very badly, and also the ancillaries to those will also get knocked off. So I think we feel that even in mid-cap and small-cap players who are leader in their space, even if it is a subsector, but he has a significant strength in terms of the market share or the leadership position, I think those companies will come out much better as compared to, let's say, tier 2, tier 3, tier 4 companies in any sector, as they would have to either raise capital or have to go on a consolidation phase of their business model, or will have to change or tweak the business models given the new requirement. Also, we should not forget that for mid caps and small caps all mid cap and small cap to prosper or to grow in a big way, you need a very strong real GDP growth rates, which in itself was not there. If you really see how GDP was coming off from 7.5 to 4.5 before this crisis hit us, and you were seeing mid caps struggling from the numbers perspective. I'm not even going into valuation, but from the numbers perspective itself, it was struggling. and this crisis has further created I would say a problem for many of the businesses to really bounce back what they would have expected as the economy would have bounced back. So as your GDP recovery has been elongated to FY22, I think some of the names will still continue to do well who are leadership position, but we view that all the mid cap and small cap will not deliver in terms of numbers, even though the prices might go up because of the huge liquidity which is there in the market.
Jinesh, appreciate your time. Thank you.